The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
We're here to talk to you or with you about investments, but doing this podcast, we don't have a process for you to call in and tell us what you believe about the market.
Correct.
But everybody has beliefs about the market because that's how we live our lives. We believe all sorts of stuff. Some of it makes sense. A lot of it doesn't, particularly when it comes to the market. So you've all seen a chart, what we call a mountain chart, that shows stock prices from centuries ago, or at least from the 20s to recently. And the major statement from a financial advisor is you cannot afford not to own stocks. You have to be in stocks. And actually, that's a pretty true statement as far if you're going to have financial resources in retirement. The stock market is one of the best ways to accumulate wealth. Now, a caveat, it's also a really efficient way at losing wealth. You must have...
It's that double-edged sword. Yeah, it goes both ways, and it goes both ways quickly.
You must have a process in order for it to work in your favor. Just simply sitting around and buying and hold. Buy the index, you've been told, and it'll all work out. As long as you don't retire or need your money in the midst of a bear market, in which case the entire plan falls apart.
Not so good, yeah.
So, but coming back to what do you believe? Belief in the stock market, in the American stock market, is a valid belief. It is an accumulator of wealth over time. It has risk associated with it, but anything that's going to accumulate wealth has risk associated with it. You have risk to deal with when you get up every day.
Correct.
You may say, well, they're not big. Sure, they're not big, but maybe you fall down the stairs or the steps on your front porch and you break your hip and you can't go to work, or you now need very expensive daily care until you recover. Those are risks. We just don't think about them because they're part of life. We expect to take them.
But we adjust for them all the time. And that's the important thing to remember. That's what we really try to drive home to our clients, is that you cannot eliminate the risk in the market, but the risk in the market changes. Sometimes the risk is very high. Sometimes the risk is much, much lower. And you need to adjust your portfolio. Thusly, if risk is very, very low, get a bunch of that. Let's buy that right now. If risk is very, very high, well, let's get really specific about what we should and shouldn't be owning, and not just own a little bit of everything, because that's when you really can get your portfolio burned to the ground. You have to pay attention to the risk and make adjustments in your portfolio based on the risk, not just based on what any investment sector has done for the past 50 years. What's it doing today? Let's look at that risk today, risk of loss, and adjust for that. And that's a way that you can mitigate the risk in the market as long as you're paying attention to it. And those buy and hold pie charts are there to try to get you to forget about it. Forget about risk. Don't worry about it. In 50 years, you'll never know this happened. Most people don't have 50 years in their investment life. So that's a meaningless statement and not a way to run your portfolio.
So part of that assumption with the pie chart is that you control risk by how wealthy you are, how much income you have, when do you need the money, and when are you going to retire?
Absolutely.
How many of those answers actually affect the market? They don't, do they?
Zippo. Yep, that's a big zero.
So what does affect the market are external forces and people reacting to them. And Perry, you just mentioned when the market's low risk, you should be in it. And when it's high risk, you should be doing something about that to defend yourself. But the pie chart portfolio does neither. It just basically says, well, you got money, let's put it in the market. and we will manage the risk based on your personal preferences, not your evaluation of the market or the financial conditions that are driving the market at the time, just your personal finances and how you feel about things. That's what drives most people's portfolio. That's how financial advisors are generally counseling people. And so, what is the way you manage risk in that model? And that is you buy a safe investment. And the more conservative you are, the safer, the more they're going to give you of the safer investment. What's the safest investment used to mitigate your personal feelings about market risk? How about bonds?
If you're looking at that world famous 60-40 portfolio, 40% of your portfolio is bonds. That's supposed to be the counterweight to the risk in equity markets.
Well, and that hasn't worked out too well recently. So let's just take a look.
Right.
This is Barclays Aggregate Bond Fund. So this has treasuries in it, corporates in it. It has long and short-term durations. It has some internationals in it. But this is what's happened over the last 3 years and 3.7 years. This is the broad bond market is off 20%. It is officially now in a bear market. This is the safety valve that investors are relying upon to get them through tough times when stocks are down. Am I missing something here? But
How does that work again? Yeah.
This doesn't look like a good chart for protecting me against a market collapse here. And
Correct.
particularly if inflation rises and interest rates continue to rise, the Fed doesn't have to raise interest rates. If inflation keeps going up, the marketplace will raise interest rates, and this will continue to erode. The safety valve that somewhere around 80, 85% of investors in this country are relying upon is falling apart. This is compounding at just about 6% a year negative. That
And
shouldn't
people,
be.
I guarantee you, no one has that built into their forward-looking portfolio return possibilities. They're looking at bonds as a consistent. I mean, first of all, they're looking at stocks too, the same way. It should go up 9% a year no matter what, because that's what it's done historically. Looking at bonds the same way. And it's important to remember all asset classes have risk. They all have the risk of losing value. And when it's happening, you ignore that at your own peril. There's no reason to sit around with a huge bond allocation that's supposed to be safe and it's lost you 20% in the last 4 years and you've done nothing about it because, yeah, but over 50 years, I'll be okay. So when time is the only safety factor in your portfolio, you're saying that our losses today are meaningless. We are so wealthy, we don't care how much we lose, and we're not going to make any adjustments. We don't have those clients. We don't have clients that say, we don't care how much we lose. Over time, we're going to win. And that is not normal for anyone. No one wants to sit around and lose that kind of money, especially when that fixed income portion, that's supposed to be the safety factor in your pie chart portfolio, and it's just not there right now.
Well, the other issue is people don't have 50 years. The bottom
Correct.
line is your first 20 years you're going to school, maybe you take a job right out of high school, work your way through college, but you're not making a lot of money and you're not saving anything as a general rule. You get married and you're broke. You have a couple of kids and now you're really broke. You thought you were before. Now you find out what real broke is.
Bingo.
That in America, the typical savings accumulation stage of life occurs after the kids are out of college and they're on their own. So that happens when parents are typically somewhere between 45 and 50. And then the first thing they do is say, man, we're done with that. Look how much money we have left over because we're not supporting the kids. It's time for us to buy a new car, an RV, take big trips, upgrade the house, remodel, get new furniture. We go through a spending spurge. And then it said, retirement's getting really close. About the time we hit 50 or 55 and we quit trying to spend money and start saving it. So our saving period runs 15 to 20 years of high income in our life. That we don't have 50 years. And by the time we get through, let's say 20 years of saving, now we're typically trying to retire and then spend the money to support our retirement lifestyle. Frankly, that takes a ton of money to be accumulated in a 2-decade period of time. And having a belief that the stock market always goes up and the bond market will always protect me is a belief without foundation, because you simply don't have time to outlive an extended bear market. Now, what's an extended bear market? 10 to 20 years. Bear markets can last 10 to 20 years before you get even. And if you're still spending money during the drawdown period, you're in deep trouble. So don't buy the assumption that just because the markets go up over time, it's okay to believe that you'll be okay. You can believe it, but the fact is, in order to actually achieve that belief is going to require a lot more work. And how are you going to get there? What are you going to do? You need some sort of plan, but that plan isn't, let's just buy some stocks and some bonds and a little bit of international. We'll diversify with a little bit of real estate and maybe put a smidgen of gold in your portfolio, and then we'll sit back and see if it all works. Oh, they don't say that, do they?
Never. They never say that. No, no. They also never say, oh, by the way, our plan only works over spans of time that you don't have. But they will spend a good deal of time on the phone with you trying to convince you not to move your money or sell anything, because their job is to just make sure you stay put, leave the money invested with their firm, and you're just going to have to live with the consequences, because they're not going to make any substantial moves to defend your investment. They're going to let the market do what it's going to do to you, and not do anything to get out of the way. We just don't think that's good enough. We think you need to be able to be nimble enough and willing to make those moves when they're necessary. When things have changed enough that you need to make a move to your portfolio, you have to be willing to say, I shouldn't be loaded up on bonds right now. Bonds aren't doing well, and not believe no. Over the long term, you're going to be fine. You don't have that kind of time, and you're not going to make that money again if you're already retired. And now you may need to be retired for 30 years, thanks to the longevity that people are experiencing today. So it's a really big deal to protect the assets you have invested and not just rely on a bottomless pit of time to bail you out. That's not realistic for your portfolio.
So the question is, how do you do that? Well, somebody has to pay attention. And maybe you say, I'm good, it's not my bailiwick, I don't find it interesting, and I certainly don't want to worry about it. That means you're going to have to hire somebody. But now you have to hire somebody who isn't just giving a sales pitch, is actually doing something about the changing metrics in the market. So I'm going to pull up an analysis of current metrics in the market that show you should be concerned right now. Not concerned that a bear market's in development, but that you should be concerned with adjusting your strategy to deal with the changes that are going on in the marketplace, not only in the United States, but globally. The changes that are happening that are impacting market right now are global factors. And
correct.
There's data available to help make these decisions. And if you're not going to pay for the data, which is not real expensive anymore, data is cheap today. You need to have somebody working with you who actually is buying the data and who's going to say, today is not the day to be owning a bunch of technology stocks. It was last year, but things have changed. They will change again. The time to be overweight technology will return. But if I'm hanging on to it today, I'm actually adding excess risk to my portfolio that probably should be dealt with in a systematic way, following a disciplined process. That's what we do for our clients. You want to talk about what your advisor's doing? We'd be glad to discuss that with you. If you don't have a process, you should at least watch our last webinar, which is on our website. The shortcut to get to our website, iriradio.com. Look at the webinar page. watch that video, because we go through step by step the data that we're looking at and how we make adjustments on a portfolio, give you some actual processes that we have used recently. We've been doing this for years. You will learn something. You will learn something. Give us a call. We'll
Absolutely.
be glad to discuss that with you. Subscribe to our podcast. There's more coming, but we just don't know what it is yet, because we'll deal with reality as it hits us in the face. You have a great day, but subscribe with the link below.